The Pioneer High Income Municipal Fund was last year's best performer among its peers with close to 7% returns. Portfolio manager Timothy Pynchon says not owning general obligation bonds certainly was a contributing factor to his success. He joins us now from Boston with more on this story. Mr. Pynchon, welcome to Bloomberg's Bottom Line.
Thank you so much, Mark.
Talk to me about why you don't own general obligation bonds.
Well, I think that we've seen a situation developing over the last several years where we've seen stress starting to form in states and municipalities. And as a result of that, we feel as though there's such an important distinction to be drawn between the bonds that are actually stressed versus the revenue bonds that we hold in our portfolios. And as a result, we think that there's still great opportunity available if we are able to distinguish between the healthy revenue bonds versus the general obligation debt that we're seeing that is so stressed in the marketplace.
Mr. Pynchon, speaking of stress, as you know, a lot of states and municipalities under a lot of stress, some of them having dire financial consequences, California, Illinois, New Jersey, just to name a few. Are we at a point where some states and municipalities might not be able to pay full interest on their bonds?
Well, I think that that's certainly the popular stance with the press these days, but we have a slightly different view here at Pioneer, and I know it's shared by a number of my colleagues in the marketplace, which is the idea that there are a number of remedies available to states and municipalities prior to a default and certainly prior to a bankruptcy. And so while we think that those states that you just mentioned are under stress, we also feel as though there are a number of interim steps prior to any default occurring and prior to a bankruptcy.
Right.
States and many municipalities are not allowed by law to declare bankruptcy. And so to get to a default is actually a situation where we think that with the taxing authority that states and municipalities have, that there is a long lead-in prior to any major default occurring.
Mr. Pynchon, I asked them, what are some of those remedies that you just suggested?
Well, certainly the ability to tax is one of those remedies. The ability to issue additional debt is another remedy. Emergency funds from state and federal levels is yet another remedy. And so what we feel is that over the course of 2011 and into 2012 is that we have an economic backdrop that is constantly improving. That's alleviating pressure as well. Along with the steps that I just mentioned, we feel as though states, through austerity programs and through cuts, are going to be able to meet most of their obligations. I think that's going to be marked by certainly some defaults at lower levels, smaller cities, smaller municipalities, but that, in my opinion, is going to be the exception rather than the rule.
Mr. Pynchon, you say that you've been able to do well in your investments because you focus on 4 areas. What are they?
The 4 areas that my fund has focused on, and which were really born in the early part of 2009, coming out of the devastation that we incurred in 2008, the airline/airport sector, the healthcare sector, specifically senior care that's not tied to Medicaid and Medicare reimbursements, the tax-exempt corporate names such as U.S. Gypsum and Boise Cascade, for instance, and then a slice of my portfolio is also using tobaccos as more of a trading vehicle.
Why these 4?
Well, again, if we trace the origins back to early 2009, these were the very deeply discounted bonds that were basically orphaned after 2008. So the ability to pick up tremendous yields at that point in time at very low dollar amounts gave us a long runway to accomplish the total return story. We followed that story through 2009 and right through October of 2010. Obviously, what we've experienced in the latter 6 weeks or so is a severe sell-off that took $24 billion out of the municipal market, but which has left our market full of value. And as value investors, we're very interested in exploiting that. And I think the savvy investor, as we move forward, understands if we're able to draw the distinction between what we saw with regard to those stressed GO debts that we were speaking of versus the healthy revenue bond debt, that we'll have a very good year coming in 2011.
Your fund's benchmark is the Barclays High Yield Index. Tell us about it.
Well, again, it's probably the most recognized index of high-yield municipal bonds, and so we use that as only a benchmark. We do not index to that. So, for instance, my weightings look very, very different than the Barclays High Yield Index. And of course, where we think we get outperformance is by sector selection and individual credit selection. And if we do that job well, then we'll continue to outperform.
Back in November, the prices of municipal funds fell at one of the fastest paces since the credit crisis. As you know, the shares of mutual funds that hold those bonds also falling as well. Is that something that could spread to other markets?
Well, I suppose there is always the chance that that will spread. I mean, we've seen an asset reallocation from fixed income to equities. That's been the popular trend over the last couple of months. We still believe that there is a credit play to be had in 2011. And said another way, that if we select individual credits on the corporate side or on the tax-exempt side, that there are still very healthy yields and a total return play as well. And so by the end of 2011, if we do our jobs well, we should have, certainly for my fund, what I look at is the idea that if we continue to clip a coupon that is basically 7%, that's a 10.5% or so taxable equivalent yield, and we get some price appreciation along the way on those deeply discounted bonds that I suggested that we hold in this portfolio, then it's easy to see our way to a mid-teen type return for 2011. And that is a healthy return compared to most any asset class out there.
Mr. Pynchon, in our last 30 seconds, is the bullish case for munis that they almost always make good on their investment?
Oh, absolutely, absolutely. If you look at the history of munis, we've seen one case after another where in troubled times munis eventually come through. There may be a lag in that performance, and we may see some bumps along the road, but I think that that 2011 promises to be a good year if we continue to draw the distinctions between healthy credits and those that are more stressed.
Tim Pynchon, portfolio manager, Pioneer Investment Management, joining us from Boston. Mr. Pynchon, thank you so much. We appreciate it.